In this video, we are going to discuss a new topic, cost of capital. Now let's go to the video. So in the previous video, we have discussed the major decisions in financial management. That is, we have already seen that in business, if you want to make any investment, we call it as capital budgeting decisions, right? Similarly, for making that investment, we need fund. Funds may be raised from various sources. It may be from shareholders' fund, or it may take in the form of borrowings, right? So shareholders fund can be classified into equity share capital, reserves and surplus, and preference share capital. Okay, then borrowings consist of debentures, bonds and bank loan. So every fund has a cost, right? So let it be the owners fund, it has a cost. Okay, so who are the real owners of a company? Equity shareholders. Hence the cost of owners fund is called the cost of equity. Borrowed fund also have a cost, which will be mainly in the form of interest. See, when comes to debt, interest is the major cost. We need to pay interest for debenture, bank loan, right? So we can give a simple definition to the cost of capital, that it is the minimum rate of return firm pays to its investors for the use of money. Let's have a look at the significance of cost of capital. That is, the concept of cost of capital is very relevant in the managerial decisions. Let's discuss some of the important points, right? Okay, first one is capital budgeting decision. Here, cost of capital is act as a discount rate used in evaluating the desirability of the investment project. For investment project appraisal, there are various techniques, that is payback period, on the average rate of return method, and net present value method, that is NPV, and internal rate of return IRR, benefit cost ratio. So these techniques in capital budgeting chapter we will discuss all these techniques in detail. Okay, here you have to understand that cost of capital plays a significant role in capital budgeting decision, right? So second one is capital structure formulation. What is capital structure formulation? That is debt equity mix, right? So for designing an optimal capital structure, what is an optimal capital structure? That is a capital structure that is a combination of the debt of equity that leads to the value maximization of the firm and minimize the cost of capital, right? So that type of capital structure, a capital structure will lead to maximization of the value and minimization of cost of capital. That is called optimal capital structure. So we have to use a judicious mix of debt and equity in the firm capital. That is the optimal capital structure, right? So you have to understand that this cost of capital has a significant influence in the capital structure formulation, right? And third one, dividend decision. What is dividend decision? That is, the dividend policy is determined according to the nature of the firm. That is, nature of the firm decide on the basis of a comparison between the rate of return and cost of capital. That is, the growth firm is R here means rate of return, and K is cost of capital. So rate of return, if rate of return is greater than cost of capital, it is called growth firm. And if rate of return is equal to cost of capital, that is called normal firm. And rate of return less than cost of capital, it is declining firm. And the dividend decision is taken on the basis of by considering the nature of the firm. Okay, so these are some of the important points which clearly tells the significance of cost of capital. See, the cost of capital is very relevant concept, and you should note all the points because it's important for both descriptive and objective type competitive examinations. So let's note the different definitions of cost of capital from different angles. So first one, cost of capital is the rate of return the firm requires from investment in order to increase the value of the firm in the marketplace, or we can say that it is the minimum rate of return or cut-off rate for capital expenditure. Now we can see the meaning of cost of capital from different angles, that is from different dimensions. First one, from firm's point of view, what is cost of capital? It is the rate at which the firm raises capital to invest in various projects. Or we can say that it is the amount paid as interest or dividend is considered as cost of capital. That is, for debenture we have to pay interest. for preference capital we have to pay dividend, right? And what is cost of capital from investors point of view? That it is the rate of return which investors expect from capital invested by them in the firm, because they are providing funds, so normally they will expect a fair rate of return, right? So cost of capital also called hurdle rate, cutoff rate, discount rate, minimum rate of return, and opportunity cost of capital. Let's have a look on classification of cost of capital. We have different classifications of cost. First one is historical cost and future cost. Historical cost is the cost which has already been incurred for financing a project, that is calculated on the basis of past data. And what is future cost? It refers to the expected cost of funds to be raised for financing a project. And next classification is specific cost and composite cost. Composite cost is also called as WACC, that is weighted average cost of capital or overall cost of capital. Okay, then what is specific cost? It refers to the cost of a specific source of a capital, that is cost of equity share capital, cost of preference share capital, cost of debenture, etc. And what is WACC? That is weighted average cost of capital or overall cost of capital. As the name indicates, it is cost of debt plus cost of equity share capital plus cost of preference share capital. That is, it is the combination of all sources of capital, right? And we have one more classification, that is explicit cost and implicit cost. Explicit cost arises when funds raised. It refers to the discount rate which equates the present value of cash inflow with the present value of cash outflow. That is the IRR rate, that is internal rate of return, which the firm pays for procuring the finance. We will discuss the IRR technique in detail in capital budgeting chapter. Okay, then implicit cost. What is implicit cost? It arises when the funds are used. Okay, it is the rate of return which can be earned by investing the funds in alternative method. That is the opportunity cost of capital. Measurement of cost of capital. That is, cost of capital is measured for different sources of capital structure of a firm. It includes cost of equity share capital, cost of reserves and surplus, cost of preference share capital, and cost of debt. Let me conclude what we have discussed in this video. That is, we have already discussed the concept of cost of capital from different dimensions and its significance and classification of cost of capital. In the next video, we are going to discuss the cost of debt, both the theoretical and practical aspect. Thank you for watching the video.